Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. I've decided to devote an entire video to one of my favorite topics, the black swan. This video covers both elements that apes need to be aware of, but more directly, the predatory short hedge fund should be concerned about. As an AMC shareholder activist, I'm far less concerned about swans because movie theaters do quite well during recessions and economic downturns, historically speaking. And I don't have to worry about what the short hedge funds do. You see, I didn't break any securities rules or laws like spoofing and layering. I didn't engage in the misuse of dark pools or payment for order flow. I'm not leveraged 60 to 1. I'm not borrowing capital at subprime rates. I didn't do any naked shorting, so I need not concern myself with billions of synthetic shares if they truly exist. While regulators have done nothing about what I deem to be the greatest financial crime in U.S. market history, they're not clamping down on my activities like they are now over the basis trade in the hands of the hedge funds. I've broken some important personal trading rules over the past 3 years, and I'll never do that again. Overcommitting to one trade, not using at least a mental stop loss, and cut your losses short, maybe even a few more. But the hedgies have also broken a long accepted rule on Wall Street, a cardinal one: don't fight the Fed. It's widely known many funds are trapped in short positions, and the market keeps moving up against them. So sit back and enjoy, because the swans are in the air, and here are the ones that may come in for a landing. The first one is for the hedgies specifically: increased oversight and regulation of non-banks. Over the past months, I've heard the Fed, the Treasury, the government, even foreign governments complain to the SEC about the leverage and even the unknown leverage of the hedgies, especially in reference to the basis trade. Hedge wars, new SEC restrictions make giant U.S. funds see red. The U.S. SEC has published new rules that will require private investment funds, which manage $26 trillion, to be more transparent in order to improve efficiency and competition in the market. These rules will be in effect in the new year. Hashtag choke on that, hedgies. The next one is commercial real estate. Headline: $6 trillion black swan everyone forgot. Commercial real estate poses a significant threat to markets in 2024 with over $6 trillion in debt outstanding. Regional banks are particularly exposed to this risk as they hold half of the outstanding commercial real estate debt. Now, if you thought January was going to be a quiet month, I have something for you to put on your trading calendar. From Bloomberg: Evergrande liquidation ruling postponed in surprise to creditors. Liquidation decision delayed as hearing adjourned to January 29th. Sounds like somebody doesn't want this on their Q4 books. China Evergrande Group won breathing room to strike a restructuring agreement with creditors after a Hong Kong court again pushed back a decision on whether the world's most indebted property developer should be wound up. So who has the biggest exposure in the Evergrande collapse? Let's ask Reuters. BlackRock, HSBC, among largest buyers of Evergrande debt. Fund giant BlackRock and investment banks HSBC and UBS were among the largest buyers of the debt of embattled Chinese real estate developer Evergrande. BlackRock added $31.3 million in notes of Evergrande's debt between January and August of 2021, pushing its stake in the company to 1% of the assets in its $1.7 billion Asian high-yield bond fund. HSBC increased its positions in the company by 40% through July, according to Morningstar. UBS increased its position by 25% through May, the latest date available in the fund's trackers database. At the same time, other large fund firms such as Fidelity, PIMCO, and Allianz cut their positions in the company by up to 47% between January and July. Growing fears that Evergrande will default on its $305 billion in liabilities has rattled global markets this week as investors worry that a downturn in the Chinese property market will spill over into the global economy. The next one is unrealized losses on our nation's banks. Banks' unrealized losses grew in the third quarter. That chart depicts the unrealized gains and losses on investment securities. I put an arrow showing that it doesn't look that good, and it makes you wonder what fourth quarter is going to look like. Reuters disclosed that Bank of America's unrealized losses on securities rose to $131.6 billion. Citigroup didn't even bother to report their third quarter unrealized losses. And back in April, Fortune warned that bank bosses are hiding $600 billion in unrealized losses to keep their mega bonuses. Here's why portfolio securities should be marked to market. I would agree. And here's a swan just for the hedgies. Hedge fund redemptions. $38 billion redeemed from top-performing hedge funds. Private equity and venture capital costs exceed profits. From December 15th this month, the best-performing hedge funds are falling victim to their own success as institutional investors such as pension funds and university endowments cut back their most profitable positions to make up for pain elsewhere. Investors yanked $38 billion from top-performing hedge funds in the 12 months to end October, having pulled out $14 billion in the year earlier period. Data from hedge fund specialist Orem Research shows. These hedge funds returned, on average, more than 19% and 18% respectively in the two 12-month periods, Orem Research said. And it looks like the redemption swan has eyes on Mr. Perfect at Citadel. Ken Griffin's Citadel to return about $7 billion in profits to investors. From December, this month again, billionaire Ken Griffin's Citadel is planning to give back about $7 billion in profits to investors after a year of double-digit returns. You know, I have to say, people, that hedge funds don't give money back. You have to ask them for it. A source familiar with the matter said on Tuesday. Its flagship multi-strategy Wellington Fund returned 14.8% this year through November, a second source said. Citadel declined to comment on the matter. Last year, Citadel also returned roughly $7 billion in profits to its investors after posting gains of over 30%. Maybe that explains why Kenny needed another $400 million at subprime rates from Bank of America. You know, most wildly successful firms don't need to borrow money that bad, Kenny. Just saying. The next one is credit card debt. American consumers continued to splurge in 2023, boosting the economy with revenge travel and expensive restaurant meals. But a lot of it was funded with debt. Credit card balances in the U.S. increased by about 4.7% to $48 billion in the third quarter alone, pushing the total to $1.08 trillion. It's the highest total in data going back to 2003. The bills are mounting at a time when the average annual percentage rate, or APR, has soared north of 20% to the highest on record. That one was from Bloomberg. And what I consider to be a cousin of the credit card swan is the silent depression swan from Zero Hedge. The Biden administration and the corporate media are telling us over and over that the economy is just fine. But the term silent depression has been going viral on TikTok. Housing, vehicles, food, and just about everything else that we spend money on is far more unaffordable today than it was during the Great Depression of the 1930s. A realtor in Florida named Freddie Smith posted a video on TikTok with some absolutely startling numbers about the cost of living in the United States today, and that is what started the silent depression trend. TikTok user Freddie Smith, a realtor based in Orlando, posted a video in September claiming that the U.S. economy is in what he calls a silent depression. In the video, which has amassed nearly 800,000 likes, Smith compares the average 2023 salary and the basic cost to those of the Great Depression to highlight the growing cost of living crisis in the country. Quote, "If you look back to the Great Depression, the house was only 3 times the average salary. Now it's 8 times the average salary," Smith said. "The car was 46% of the salary. The car today is 85% of the salary. And here's the craziest part. The rent was 16% of the average salary. It's now 42% of the average salary." Of course, he's right on target. There's a reason why 62% of the country is currently living paycheck to paycheck. You can't have a swan party without the inflation swan. More specifically, the resurgent inflation swan. From a Morningstar article titled 8 Market Risks Investors Face in 2024, inflation fell markedly from its 2022 peaks both in Europe and the US, but upside risks are still in place. Quote, "It is clear that the fall in energy prices was the overwhelming driver of the headline rate falling to 2.4% in November in the Eurozone," says Morningstar European market strategist Michael Field. However, energy prices can be volatile, so they can easily rise again in the coming months. If inflation surges once more, central banks will be forced to increase interest rates, despite market expectations of a cut sometime next year. This could also impact on corporate earnings and heighten recession risk. This next one goes by the name of U.S. tech bubble. Societe Generale warns of the biggest black swan event in 2024, the bursting of the U.S. tech bubble. As we enter 2024, Albert Edwards, the global strategist known as Societe Generale-sponsored ADR Bear, issued a warning in his last Global Strategy Weekly of 2023 about potential variables that could shake the global financial markets in 2024. In the report, Edwards focused on the instability of the U.S. technology industry and its potential impact on the overall market. He also analyzed the possibility of an economic recession in the U.S. Edwards warned that the bursting of the U.S. IT industry bubble could be the biggest black swan event in 2024 that could drag the entire U.S. market into a recession. The next one is simply named war and starts with the possible expansion on the current conflict in the Middle East. After Hamas attacked Israel on October 7th, many observers are worried about an escalation to the conflict involving other nations in the Middle East. This could have an impact on energy markets, causing oil price shocks, which in turn could increase recession risk for vulnerable economies. Though most commentators have been relatively agnostic about the risk of Israel's own markets finding themselves at the epicenter of a financial crisis, the situation hinges on the role played by Tel Aviv in any ground or air conflict. Of course, another war swan is centered on a conflict in Europe. The prolonged conflict between Ukraine and Russia could still impact energy and food markets, which in turn could increase recession risk for European countries. The Eurozone's economic activity broadly stagnated in 2023. In September, the ECB revised down projected gross domestic product growth, particularly for this year and next, due to greater contractionary effect from tightening financing conditions and the weakening international trade environment. And now the red war swan, China. On November 15th, U.S. President Joe Biden and Chinese President Xi Jinping held their first face-to-face meeting in a year in San Francisco in an effort to stabilize increasingly strained relations. But the risk of conflict remains, and that is already causing global economic uncertainty and a rapid reshoring of businesses spooked by the consequences of either a war of words or a war of arms. Just 3 days ago, we learned from NBC News that Xi warned Biden during that summit that Beijing will reunify Taiwan with China. The next red swan is appropriately named the Chinese economy. Many observers forecasted China's post-COVID-19 reopening would boost growth in 2023, but that hasn't turned out to be the case. One of the key reasons is the real estate crisis. Because real estate represents between 15 and 30% of the country's GDP, depending on how you define the sector, economic weakness could still present a challenge in 2024. If China's economy is stagnant or it collapses, recession risk increases also for its trade partners. That means us, guys. This one is perhaps my favorite bird of them all, the election swan. Artificial intelligence is predicting there won't even be an election. I'm waiting for them to charge Trump with the Kennedy assassination, the ballot box bombshell. There are two important elections in 2024 in the UK and the US. As they appear on the horizon, MIM experts suggest the two primary questions for investors revolve around fiscal responsibility and the impact of potential policy changes. The direction the wind blows on these issues could determine the course of the markets. A UK poll must take place no later than January 2025 and has been slated for October, though that may change with events themselves. U.S. presidential elections are fixed for November 5th, 2024. The European Parliament will also hold elections between the 6th and 9th of June. Prior experience of this kind of event risk shows big changes can cause sell-offs in so-called risk assets, equities, and corporate bonds. Meanwhile, government bonds tend to act as a store of value because the long-term financial stability of governments themselves isn't necessarily at play. There are, however, notable exceptions to this rule investors should always be aware of. Now this one has the coolest name, Recession Strike. I got it from this Markets Insider article titled, "Here are the biggest risks to stocks in 2024, according to Wall Street. Recession strikes. Though the Fed is expected to dial back interest rates soon, the economy still risks tipping into a recession thanks to the accumulated financial tightening that's already taken place in the economy. Even a hint of a recession could send stocks plunging. French bank Societe Generale warned, and there are parallels between today's market and conditions seen in 1987. That was the year the market was roiled on Black Monday with the Dow plunging 22% in a single trading session. The equity market's current resilience in the face of rising bond yields reminds me very much of events in 1987, when equity investors' bullishness was eventually squashed, strategists at the financial services firm said in a recent note. They added that stocks could see a devastating blow if a recession were to strike. I named this next one Bubbles, but don't let the cute name fool you. It's the freak nastiest swan of them all. From the same article, the debt bubble bursts. Universa Investments, a hedge fund that counts the Black Swan author Nassim Taleb as an advisor, recently predicted stocks would experience a crash even steeper than 1929. That's due to a huge debt bubble forming in markets when interest rates were ultra low, which is set to pop as borrowing costs remain higher for longer. Quote, "We are in the greatest credit bubble of human history," Universa's chief investment officer Mark Spitznagel said in an interview with The Intelligencer. It's entirely because of artificially low interest rates, artificial liquidity in the economy that has really happened in a big way since the great financial crisis. Markets saw a wave of corporate debt defaults so far this year as rates rose and refinancing became more expensive for companies. A worsening pace of debt failures could spell trouble for stocks, and a tougher credit environment combined with a full-blown recession could result in nearly $1 trillion of corporate debt defaults, Bank of America previously estimated. Now, the pandemic may have been the best thing to ever hit the Adam Aaron household. His comp plan doubled in 2020. But this swan named Pandy is the only one feared by apes. The next pandemic is coming, and the world isn't ready. From The Independent, none of us want to live through anything like the COVID-19 pandemic again, but the reality is that the next pandemic is coming. The bleak fact is that there are plenty of other pathogens out there with the potential to cause even greater destruction. 3 years on from the declaration of the worst pandemic in living memory, we are still feeling the effects. More than 6.8 million people are dead. 1.6 billion students have had their education disrupted, and the global economy will have lost more than $12.5 trillion in 2024, according to IMF estimates published last year. COVID-19 wreaked havoc on incomes, health services, mental health, and our children's education. We must do what we can to make sure this never happens again. It is a question of when, not if, another pandemic strikes. Modeling suggests we have a 38% chance of experiencing another pandemic in our lifetime. That is a huge risk to bear, but that risk is simply a matter of timing. Experiencing one pandemic does not reduce the threat of the next or mean that it couldn't happen this year or next. One thing is clear. Despite everything we have learned, we are not ready for the next pandemic and have even seen cuts in our health security infrastructure. I wanted to end this video with a white swan for us, which means a black swan for the hedgies. These are the biggest concerts touring in the US in 2024, which means one thing for AMC's new distribution business: potential surprise concert films at AMC theaters. I see Olivia Rodrigo, New Kids on the Block, Madonna, Bad Bunny, oh, Jordan's going to that one, Billy Joel, Drake and J. Cole, Nicki Minaj, Stevie Nicks, Journey, The Rolling Stones, Tim McGraw, Metallica, Green Day, Blink-182, Foo Fighters, and the only one Uncle Frank is going to see, Red Hot Chili Peppers. Any one of these can be adapted to be a concert film. And a parting comment from Slate: movie theaters are figuring out a way to bring people back. The trick isn't to make event movies, it's to make movies into events. AMC is the biggest theater chain on the planet. It has a completely updated business model, and if you want to bring content to an indoor audience, you have no choice but to go through AMC. That's right, hedgies. Our new distribution business isn't going away. It's only going to get bigger, and eventually someone bigger than you is going to want to own and control that access and that space. Tick-tock, melon farmers. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.